Coming up on Business Incorporated. China rejects allegations it may grab Ugandan airport if country defaults on loan. And Bank of Tanzania plans launch of central bank digital currency. Zimbabwe plans strategic spending of special drawing rights fund. All right, let's take a look at how your money is performing at intraday, starting off with trading activities from major equity markets here on the African continent. See, Nigeria's NGX and South Africa's index traded in different territories at intraday. The NGX was down marginally by 0.02%. It could be the switch by close of trade, while South Africa's GSC index looking quite impressive, up over 1% after Friday's sell-offs on the Omicron scare. Egypt's EGX 30 was in the red, down over 0.5%, while the Nairobi Stock Exchange closed Friday's session in positive territory, up 1.62%. We cross over to the Middle East now, where major equities were mostly positive at intraday. The Abu Dhabi index was up a massive 2.13%. Dubai's index also looking good, up over 1%. Still within the region, we see Saudi Arabia and the Qatari index were not left out, up 0.46% and 0.06% each. And you see European stocks plummeted on Friday amid fears of new Omicron COVID-19 variants. For more now, let's cross over to Berlin with Chiponda right there. Great to have you, Chiponda. We see investors and markets are still trying to understand just how the new COVID variant Omicron could affect the pandemic. Many governments across the world have, increased travel restrictions and even closed borders to, stem the spread of the virus. What are investors making of Omicron today?
Well, compared to the reaction we saw on Friday, Laddie, things are not as bad as they were on Friday. There's been a few minor gains here and there, so it's not like the sell-off that we saw on Friday, so things are slightly calmer on the markets. They're still trying to figure out just exactly what this new COVID variant Omicron means for the pandemic and, of course, for economic recoveries. But as far as we know, of course, it's going to take a couple of days, maybe even weeks, to get all the information that we need. There's more information regarding vaccines, for instance, if they're all effective enough. More information will be coming from Moderna in the coming weeks, and also BioNTech, Pfizer will be releasing information, or whether they need to create a new vaccine that is more responsive, or whether the one they already make is responsive enough to this COVID variant. So definitely in terms of the market reaction, it's much calmer. It's not as bad as before, but of course those travel restrictions are a lot of trouble for the tourism industry and the travel sector. We've seen new figures coming from the United Nations World Tourism Organization, and they say that the tourism industry and the travel industry have lost as much as $2 trillion in business this year alone, because of course of all the measures that we've seen to curb the spread of the coronavirus in several countries. And of course the fact that we're seeing more of such measures taking place now spells bad news, because of course this holiday season, the holiday period, December is a major season for travel across the world, as most people head home for Christmas and for New Year, and that's going to be definitely bad for the travel and tourism sectors in particular. So definitely there's bad news, and investors are watching that, but it's not as bad as it was in that market sell-off we saw on Friday.
And right, it's actually funny, most of the traders actually switched to pandemic stocks, and they were actually up on Friday. But Germany is still fighting a COVID surge, and new figures from a poll by the country's Retail Association show that only 1 in 5 German retailers are currently satisfied with holiday sales. Can you tell us more about this?
Exactly. Only 1 in 5, as you say. So 4 out of 5 German retailers are not happy with their sales right now. And that's obviously linked to the COVID restrictions, the new COVID restrictions we have also across the country, in parts of the country where there are more severe cases or levels of COVID infections. Then, of course, there's even more restrictions. And what the kinds of restrictions we're seeing are people, being having to show that they are vaccinated or they've recovered from a COVID infection fairly recently in order to be able to go shopping or to receive some services. Also, on public transportation, you have to either be tested negative or have a COVID pass, a COVID vaccination, also a recovery to be able to be on public transportation, for instance. So all these measures are reducing the amount of foot traffic in German retail. And retail traffic or foot traffic, people in stores, that is down 40% compared to pre-pandemic levels at this time of the year. So that is definitely bad business for the retail business, because of course, when you look at a city like Berlin, for instance, which is a major also travel destination, so part of that retail is from tourists and people visiting the city. That is all, none or has most of it has disappeared, at least during the pandemic. And that is something that is really hitting retailers very badly. And we've seen also Christmas markets closing here in Germany. And it doesn't look like it's going away very soon in terms of measures being, relaxed or anything, because of course we have a COVID surge in Germany. We have infection rates which are at the highest levels we've ever seen. It's just going from one high to the next. And we've heard policymakers saying that they might actually have a lockdown potentially. Obviously, it's hard to say whether there will be a lockdown, because we're also in a transitory period, a transition period, where the government, we're supposed to get a new government early December in Germany, and we still have the old government, so it's not quite clear who's deciding what, when, and where. So there's a bit of a tricky situation here in Germany, but it's obviously a dire situation in some parts of the country, because we've also seen patients being airlifted from areas where, hospitalization rates for COVID have pretty much brought the capacity of the hospitals to the highest level, and patients have to be airlifted to other parts of the country where the situation isn't as bad. So definitely, it's a bad, it's bad news all around when we look at the COVID situation here in Germany, because of course we have these high infection rates, and then we have the COVID variant, the new one, Omicron, to worry about. So definitely, there's a lot happening, and a lot is being, of course, watched by the investors. Yeah.
Quite a lot to chew. And speaking of a lot, we see inflation is up in Europe and energy prices also soaring. Is there a relationship here?
Well, the relationship perhaps is what it does to your wallet, because of course we know that consumers are affected and they feel the pinch. Oil prices have increased from their levels last year. They've nearly doubled, and then we've also seen as well inflation levels being at an all-time high, and we're expecting perhaps inflation hitting as much as 6% for November here in Germany. So obviously people are feeling the pinch, and of course for governments across Europe, in the Eurozone in particular, that is trouble, because of course people can feel the pain, and that is not a good sign. But it is hard to say whether this will be going away very soon. We've heard from ECB policymakers saying that this is a transitory period. It's just sort of a temporary issue, and they don't expect this to last. Obviously, analysts don't agree with them. That is the problem that that some people would call it a problem, an issue. There's obviously no agreement whether this is transitory or this is here to stay with us. Oil prices are high, and of course, that is something that we have to also watch and look out for. But there's also an energy crunch in general. Natural gas prices are also at higher levels, because of course we're not getting as much natural gas deliveries from Russia, because there's a new oil pipeline, the Nord Stream 2 pipeline, which is not in operation because it hasn't received approval from European authorities. So that is a lot is happening. Let's just put it that way, wherever you look.
All right, and the word that this is actually the year of the word transitory. Had that word a lot this year. But what else will the markets be looking at this week?
Well, oil prices for sure. I just mentioned that because, of course, there's the OPEC plus group of meetings, which will be on Thursday, on December 2nd. Oil producers who are in OPEC Plus are meeting to discuss January oil supply, and they will be talking about how to respond to the fact that the United States last week it announced that it would be releasing 50 million barrels of oil to help tame high oil prices, which have doubled in the United States. So gasoline has doubled in the United States, and the government is trying to tame that by releasing its oil reserves onto the market. And oil producers, they want to say, or will be hopefully telling us on Thursday how they plan to respond to that. But of course, there's also something else that has been thrown into all of this, and that's the new COVID variant, the Omicron. It's obviously affecting supply, not supply, but demand, because of course, travel restrictions means less flights, and less flights means less demand for oil. So it will be interesting to see how they respond to all of that on Thursday, or if they do say something on Thursday, it will be interesting to watch that. And investors are watching that very closely.
Oh, yes, we're watching that. We're going to be tracking the outcome of that meeting. All right, Chiponda Chimbelu, right there in Berlin. Thank you so much for the update.
Likewise, Ladi.
All right, moving on now, we see major markets in Asia Pacific largely fell today as investors continue to monitor developments surrounding the recently discovered Omicron COVID variant. Hong Kong's Hang Seng Index slipped 0.95% to close at 23,852 points. Hong Kong's listed shares of Chinese tech giant Newton lost 7% after the firm posted a loss of about 10 billion Chinese yuan for the 3 months ended September 30th. Mainland Chinese stocks closed mixed, with the Shanghai Composite falling fractionally to 3,562 points. Shenzhen Component nudged higher at 14,810 points. In Japan, the Nikkei 225 declined 1.63% to a close at 28,283 points, while Topix Index dropped 1.84%. South Korea's Kospi shed 0.92% at 2,909 points. Shares in Australia also slipped. The S&P ASX 200 fell 0.54% to 7,239 points. And MSCI's broadest index of Asia Pacific shares outside Japan shed 0.41%. And stock futures moved higher in early trade today following Friday's big sell-off. Investors monitor the latest development related to the COVID Omicron variants. Futures on the Dow Jones Industrial Average gained 208 points. S&P 500 futures added 0.82%, and NASDAQ 100 futures rose 1.07%. Stocks are coming off holiday shortened session Friday, in which the Dow posted its worst day since October 2020. Dow was down 905 points, and the NASDAQ Composite slipped 2.2%. The three major indexes were negative for the week. And Brent crude futures climbed $3 or 4.2% to $75.77 a barrel after falling $9.50 on Friday. U.S. West Texas Intermediate crude was up $3.27 at $71.42 a barrel, having tumbled $10.24 in the previous session. Oil prices crashed together with other financial markets on Friday by more than 10%. The largest one-day drop since April 2020. Oil prices rose today, recouping some losses after Friday's plunge of about $10 a barrel. Investors look for bargains at the market, and we've seen a bounce right now in the oil market. And gold prices edge higher as concerns over the impact of the possibly vaccine-resistant Omicron coronavirus variant supported the precious metals safe haven appeal. Spot gold rose 0.1% to $1,793 per ounce. Gold futures advanced 0.47% to $1,793. The Omicron coronavirus variant spread around the world on Sunday with new cases found in the Netherlands, Denmark, and Australia, even as more countries impose travel restrictions to try to seal themselves off. Spot silver rose 1.1% to $23.38 per ounce. Platinum gained 2.3% to $976. Palladium was up 2.7% at $1,794. And Tanzania started exploring a central bank digital currency. Country is following the footsteps of Nigeria, which launched its own digital currency last month. Tanzania's central bank governor announced the country's CBDC plans at the 20th conference of the financial institutions. The Apex Bank governor said this move was inspired by Nigeria's launch of its own CBDC, the e-Naira, last month. Nigeria partnered with a German fintech to launch a digital currency to complement the physical Naira. West African country is the second to officially have a CBDC after the Bahamas, which launched its own last year. And we'll take a break now. We'll get more stories on the African continent after the break. Do stay with us. Welcome back. Still watching Business Incorporated live on Channels Television. Well, major markets were rocked on Friday when the Omicron variant of COVID-19 was first identified in South Africa. Country scientists were quick to inform the global health leaders of the new mutations they had found. Those scientists have little information about the new variant and are uncertain where it originated. Several countries, including the United States, Canada, the United Kingdom, and the European Union, announced almost immediate travel bans from South Africa and other southern African countries. How would all of this impact recovery of the tourism industry in southern Africa? Let's talk to Matt Kinnigan now, practice lead Sub-Saharan Africa at Frontier. Great to have you on the program.
Hi, thanks for having me on the show today.
Yeah, so how will these, latest travel bans affect the recovery of the tourism industry to southern Africa?
Yeah, so these travel bans are really a major setback, and this is because the region's tourism industry, especially in South Africa, had shown very positive signs of coming out of the COVID slump. So South Africa's tourism industry, for example, had been severely depressed well until the last couple of months. It's worth remembering that South Africa was only removed from the UK's red list, which involved a hotel quarantine when you arrived in the UK. So it was only removed from the UK's red list 6 weeks ago. And so we were only starting to see the beginnings of a tourism recovery. So certainly this is a significant setback. What we are expecting to see is in the longer term, tourists from Europe, North America will see long-haul travel to countries in Southern Africa as particularly high risk. And this is because the rapid pace at which these travel bans have been introduced does create a significant amount of uncertainty for travel to the region. So certainly we are expecting the travel industry, the tourism industry in Southern Africa to be quite depressed for the next 3 to 6 months as a direct result of these new travel bans.
Right, and do you expect Southern African governments to introduce new lockdowns to contain this Omicron variant?
So our base case is no at the moment. And this really is because of recent historical trends in Southern Africa are that governments have prioritized keeping economies open throughout the pandemic. After the first lockdowns, which were economically quite damaging, which resulted in quite a lot of social suffering and very high unemployment, especially in South Africa, governments have made sure that they've kept economies more or less open. So we expect this to continue for the foreseeable future. However, it really does depend on whether this new Omicron variant results in much worse coronavirus disease. So if it does result in intensive care beds in South Africa, for example, being overwhelmed, then we could see a tightening of commercial restrictions. The government in the past has introduced alcohol sales bans. It has tightened the nighttime curfew, for example. And in the worst case scenario, we could see maybe a lockdown of a couple of weeks. But really, our base case view is that governments will do everything they can to keep economies open to protect economic recoveries across Southern Africa.
Right, remains to be seen. But what does this Omicron variant mean for the economic growth outlook in Southern Africa?
So at the moment, the impact will be relatively mild on the growth outlook in our view. So certainly countries like South Africa, possibly Mozambique, that pre-COVID were very dependent on tourism for a degree of consumer spending, they will be affected the most by the new Omicron variant. However, the major drivers of growth for Southern Africa in 2022 are expected to be elevated commodity prices and investment into the region. So at the moment, we don't know enough about the Omicron variant to really say whether it will affect global economic growth in 2022. Our base case view at the moment is that commodity prices will remain relatively high, but it all depends on whether commodity prices fall as a result of this Omicron variant. And this is because countries like South Africa have benefited from high commodity prices. So this really will have a significant impact on the growth outlook, especially export revenues for countries like South Africa.
All right.
If commodity prices do fall.
All right, we'll keep tracking that, see how it all goes, how it all plays out. Well, thank you so much, Matt Kindiger, practice leader at Sub-Saharan Africa Frontier View. Thank you for coming on the program.
Thanks very much.
Meanwhile, South Africa's president has condemned travel bans enacted against his country at its neighbors over the new coronavirus variant, Omicron. Cyril Ramaphosa says he is deeply disappointed by the action, which he describes as unjustified, and called for the bans to be urgently lifted. The UK, EU, and US are among those who have imposed travel bans. Omicron has been classed as a variant of concern. Early evidence suggests it has a higher reinfection risk. Do take a listen.
We are deeply disappointed by the decision of several countries to prohibit travel from a number of Southern African countries, including our own, following the identification of the Omicron variant. This is a clear and completely unjustified departure from the commitment that many of these countries made at the meeting of the G20 countries in Rome last month. Now, these restrictions are completely unjustified and unfairly discriminate against our country and our Southern African sister countries. The prohibition of travel is not informed by science, nor will it be effective in preventing the spread of this variant. The only thing the prohibition on travel will do is to further damage the economies of the affected countries and undermine their ability to respond to and also to recover from the pandemic. We call upon these countries that have imposed travel bans on our country and our other Southern African sister countries to immediately and urgently reverse their decisions and lift the bans they have imposed before any further damage is done on our economies and to the livelihoods of our people.
As President of South Africa there, Cyril Ramaphosa. Well, moving on now, assets of banks operating in Kenya grew by £500 billion in 3 months from June to September 30th. According to the Central Bank of Kenya's third quarter commercial bank credit officer survey covering 39 banks, aggregate balance sheet increased by 2.5% to 5.8 trillion shillings in September from 5.27 trillion shillings in June. This growth is attributed to high deposits recorded as businesses slowly recover from the COVID-19 economic pressures. The Egyptian parliament has approved to amend some categories of custom tariffs, including introducing a 10% tax on mobile phone devices after they were exempt from a tax, as well as 5% on photovoltaic cells. According to the Budget Committee, the decision aims to make appropriate adjustments to the customs tariff and develop its own system in line with the economic changes and improve the investment environment in Egypt to address some custom distortions in order to increase its competitiveness. The Technical Secretariat of the Supreme Council for the Customs Tariff completed studying the proposals of these companies with the participation of representatives of the Ministry of Trade and Industry, where it was agreed. And China has rejected allegations that it may grab Uganda's Seoul International Airport if the East African country fails to service a $200 million loan for the expansion of the facility. A parliamentary probe last month concluded that China had imposed onerous conditions on the loan, including potential forfeiture of the airport in case of default, sparking public outrage. The Chinese embassy in Uganda, referring to a local headline, said late on Sunday that the malicious allegation that Uganda surrenders key assets for China has no factual basis and is ill-intended, only to distort the good relations that China enjoys with developing countries, including Uganda. $958 million of the special drawing rights allocated to Zimbabwe by the International Monetary Fund will be used over a 3-year period, with $311 million expected to be released this year. According to the Minister of Finance, the funds will be prudently used with accountability and transparency to support projects in the social sectors for health, education, and boosting foreign currency reserves. The 677 million SDR was allocated in August this year to help countries cope with the fallout from the coronavirus. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Bye for now.